Hello everyone and welcome to this short lecture on financial accounting. We are just going to go over the basics. Now I think oftentimes people are afraid of accounting, but there's no reason to be afraid of accounting. As you're going to learn, it is super simple and I actually think it's pretty fun. So I thought a fun way to start this out would be to try to define accounting. So you know what I did? I went to my friend Google and I said, Google, what is accounting? Okay, and I pulled up the top 4 answers that came up, okay? The Oxford Dictionary says that it is the action or process of keeping financial accounts. Investopedia says it's the process of recording financial transactions pertaining to a business. Accounting Coach says it's the recording of financial transactions along with storing, sorting, retrieving, summarizing, and presenting the results in various reports. Lastly, Wikipedia says it's the measurement, processing, and communication of financial and non-financial information about economic entities. Okay, well, clearly all 4 of those are correct. Okay, I think the best descriptions are probably either Accounting Coach or Wikipedia or some combination of the two, okay? So really, we often hear that accounting is the language of business, okay? And it is. It's how we are able to communicate meaningful financial and non-financial information to others to help them make better decisions related to a business. So let's look at 2 basic types of accounting. We've got financial accounting and managerial accounting. Okay, I'm going to tell you that the bulk of this course is going to focus on financial accounting, but it's important to understand the difference between the two. Okay, the biggest difference between financial accounting and managerial accounting is simply who the information is designed to serve. Okay. Financial accounting is designed for external users. Okay, those are people outside of the company. Think investors, creditors, regulatory agencies, suppliers, customers, vendors, those folks outside of the company. Okay, and we're going to talk about this a little bit more, but generally speaking, financial accounting must follow generally accepted accounting principles or GAAP. Okay, we commonly call this GAAP. All right. On the other hand, managerial accounting information is designed for internal users, specifically management. Okay. These are the reports that we put together for management to help them make better decisions on behalf of the company. Okay. To make better decisions for the company. Now, when it comes to managerial accounting, we have a lot more flexibility as we are not restricted by U.S. GAAP. When it comes to managerial accounting, we have a lot of flexibility. We can essentially put together reports in a way that is going to benefit management most. Okay, but again, our focus is primarily going to be on financial accounting. It is designed for external users. We're going to report information about the company to parties outside of the company. And to ensure integrity, comparability, and consistency, we are going to follow generally accepted accounting principles. All right, now let's touch on some different types of businesses, okay? Now, the first thing that I want to point out here is each business is probably going to fall into at least one category on the left side of this slide and one category on the right side, okay? The left side describes what kind of business they are in, and the right side describes what kind of ownership structure they have, okay? So let's look at the kind of business first, okay? Service providers, okay? Simply put, this is someone that provides a service instead of a good, okay? If we want to think about big companies, we could think of, Comcast, Disney, places like that that primarily provide services. Netflix would be a good example. Merchandisers, okay? Merchandisers are companies that buy a finished good from one company and resell it to customers at a higher price, okay? Any place that you shop probably falls into the category of merchandisers, okay? This could be Walmart, Target, the grocery store, a store at the mall. Again, just about anywhere that customers shop is going to be a merchandising company. Sometimes you'll also hear this called retailers, okay? Merchandisers and retailers are normally synonymous. Normally they mean about the same thing, okay? Manufacturers, on the other hand, these are companies that buy raw materials and convert those raw materials into a finished good to sell them to other companies, okay? Common examples might be General Motors, they build cars, right? Procter & Gamble, Kraft Heinz, anybody that makes a product and then sells it to a retailer or merchandiser for resale is going to be a manufacturing company. Okay, now, so again, that's the kind of business that they're in. Now we're going to think about the ownership structure, and that's what we see on the right side of the slide. This is the ownership structure, okay? And keep in mind that within each ownership structure, you can have any of these three types of companies, okay? So a sole proprietorship, okay? This is a company owned by a single individual, okay? So this is going to be, I'll guarantee you, if you look around where you live, there are tons of local businesses, that are owned by one person. They may be providing a service. It may be a little shop or boutique, or maybe they're actually making something and selling it, okay? But if it's owned by one person, it's a sole proprietorship. A partnership. A partnership is going to be a company owned by two or more people, but without stock. Okay, so they are not selling shares of stock in the company, but the company is owned by two or more people. That's going to be a partnership. A corporation. Now, this is what we normally think about when we think big business. Okay, big businesses are corporations. They sell shares of stock. The owners of the company, thus, are the stockholders, the people who own the shares of stock in the organization. Now, we're going to talk a little bit more about our reporting framework, okay? Earlier when I mentioned financial accounting, I said that we were going to follow generally accepted accounting principles. In the U.S., that is what we follow to report. Now, if a company is publicly traded, that means their stock is available on an open stock exchange, okay? Think big companies. They have to file their financial statements with the Securities and Exchange Commission on a quarterly basis. And the Securities and Exchange Commission says you absolutely have to follow generally accepted accounting principles, okay? Now, if a company is smaller, in theory, they do not have to follow generally accepted accounting principles, okay? If this is a little, a sole proprietorship or a little partnership that's not, not looking for outside investors, and they're not reporting their financial results anywhere, they're not going to be bound by generally accepted accounting principles. But for our purposes in this course, we are going to focus on generally accepted accounting principles, because I can tell you, even though the smaller companies may not be legally bound to them, they will definitely benefit from following them in their financial reporting. It's going to give you a much more accurate and reliable financial results, okay? So, the Securities and Exchange Commission is the one that mandates that we must follow U.S. GAAP. However, the Securities and Exchange Commission has actually delegated that particular authority and responsibility to the Financial Accounting Standards Board, which we sometimes call the FASB. So it is the Financial Accounting Standards Board that develops and provides the guidance that we use, which is called Generally Accepted Accounting Principles, or GAAP. Okay? Now, when we talk about financial reporting and financial statements, we are really talking about four key statements, okay? Everything that we're going to focus on in this course, everything is geared towards the preparation of these 4 financial statements. The income statement, the statement of equity. Now, I can tell you sometimes this one will be called different things depending on the ownership structure of the company. I just put statement of equity because that's pretty simple. Sometimes you may see it called the statement of retained earnings. If it is a sole proprietorship, it may be the statement of owner's capital. It could be the statement of stockholders' equity or the statement of shareholders' equity. It'll go by lots of names. But at the end of the day, it is a statement focusing on the equity section of the balance sheet. Okay, which brings us to the next statement is the balance sheet. All right, and we're going to talk more about what's on the balance sheet in just a moment. Okay. The last statement is the statement of cash flows. Okay, so these 4 general purpose financial statements, the income statement, the statement of equity, the balance sheet, and the statement of cash flows are effectively our end result in financial accounting. Everything that we learn to do in financial accounting is about creating these reports and making them accurate and reliable and relevant and useful for people who are using them to try to make good decisions. Now, what is on the balance sheet? The balance sheet is where we are going to learn the accounting equation. The balance sheet will prove that the accounting equation must always be true. And the accounting equation says total assets equals total liabilities plus total equity. Okay? Assets equal liability plus equity. All right? This equation must always be true. Okay? It will never ever fall out of balance. It will always be true. And you'll learn more about that in your studies as you look at how transactions affect these different elements within the financial statements. All right? All right. Now, let's talk about the types of accounts and what we will find in there. Now, let me say these 3 accounts on the bottom, the reason I have them grouped together and pointing towards equity is because all of these items eventually roll up into equity. Okay, that's how they land in the accounting equation. They're separate accounts, but they land in the accounting equation because they eventually end up in equity. All right, and the more we learn, you're going to learn how those items move into equity. But just know that that's where they are. That's where they live. All right, we'll put it that way. They live in equity. All right. Okay, so assets. Effectively, assets are going to be economic resources that the company owns that they expect to provide future benefit. Some of your most common examples of assets are going to be cash, accounts receivable, inventories, investments such as marketable securities, property, plant, and equipment, and even intangible assets, which we'll learn about later on in the course. All right, so those are some common examples of assets. Liabilities are effectively what we owe to other people. Normally, it's money, okay? Normally, it's cash. Common examples of liabilities are going to be accounts payable, salaries payable, taxes payable, interest payable. Sometimes you'll see accrued expenses. If you see accrued expenses, that's probably a liability. Sometimes you'll also see something called, and we'll learn more about this later in the course, but you'll see something called unearned revenue. This is basically when a customer pays us in advance. Think of it kind of like a customer deposit, and we owe the customer work. That too is a liability. A liability is any future obligation that we owe to someone else. Again, normally it's cash, okay? Normally. But it's what we owe to others. All right, so assets are what we own. Liabilities are what we owe to others. Equity is simply the difference between the two, okay? Equity is comprised of 2 basic components. One, contributed capital, all right, which we're going to learn about, and that is when the owners of the organization contribute to the business by purchasing shares of stock, okay, by purchasing ownership in the business. Okay, so that's contributed capital. The other element is retained earnings. All three of these guys constitute retained earnings. Okay, retained earnings are essentially the accumulation of the company's net income, net losses, adjusted by any dividends or withdrawals that are paid out to the company's owners. Now, interestingly, you're going to learn that revenues, which are reported on the income statement, minus expenses, which are reported on the income statement, give us net income. Okay? But again, all three of these will eventually roll up into equity. So the accounting equation, I'm going to go back to it one more time. The accounting equation says total assets equal total liabilities plus total equity. This will be true throughout the course, and I think you're going to learn some very useful skills that you can apply in the future. If you encounter any questions at all, please feel free to reach out.